Hello, this is Dave Tolson again. Thanks for joining us. This is part two of a two-part series that we've entitled Market Mayhem and My Retirement. In the first part, we talked about kind of the nature of markets, the nature of portfolios, and in some kind of historical context to give you an idea of how the news is today versus how it may pan out or how it has panned out in the past. And then some of the things you can do to your portfolio to give yourself a leg up on dealing with some of the realities that are going on in the marketplace. Now, yesterday's session and this session, part one and part two, are not intended to be financial advice by themselves, nor tax advice. If you have questions that as a result of watching part one or part two, we'd love to visit with you. Give us a call, come by and see us, schedule an appointment, or we could do a Zoom session. But anyway, we've got a lot to talk about, so let's dive in. I'm going to share my screen and we'll go from there. All right, here we go. In part one, we talked about, again, nature of capital markets. Current short-term market performance is driven by midterm elections, the Ukraine war, post-COVID inflation, Fed rate hikes, and recession fears. Markets have been very resilient over time. Markets are really political party agnostic. There's been strong post-election performance. Well, in a midterm election year, there's the post-election performance is about twice what it is in non-election years. There have been positive market returns during rate hikes, inflationary periods, and about half the recessions that we experienced. Markets tend to revert to a mean. Sometimes they underperform, sometimes they overperform, but they do revert to a long-term mean. Markets are dynamic. They move around a lot. In the S&P 500 intra-year, there's a high to low excursion of about 14%, even when the year finishes positive, and about 15% in years where the S&P finishes negative. Timing the market is very hazardous, very low margin for error. If you miss just the 10 days in 10 years, it'll cost you about 44% of your gain. If you miss just a little bit more than 1% of the best days over 10 years, it'll cost you about 75% of your gain. Over 30 years, that's cost investors about 3.5% a year in terms of return they could have had. Nature of portfolios, if you're willing to take more risk, you have the opportunity for higher gains, but not the guarantee. Single stock risk is about 3 times what a diversified stock only portfolio would look like. Adding asset classes reduces risk and increases returns, or has the potential to. Different asset classes perform differently in the face of varying economic and political environments. It's a predictable science. If you add low to non-correlating assets together, the sum of the results of the portfolio tend to be better performance than not. The lower the volatility your portfolio is, all that other things being equal, you'll accumulate more money over time. And the truth of the matter is, most investors don't need to take all equity risk, nor could they stomach it, or can they really stomach it, kind of from an emotional standpoint. So, talking about what's this all got to do with retirement planning? Well, let's talk a little bit about our approach to retirement planning, and then talk about some history. So, kind of the basics of retirement income planning are: what are the value of my current assets? What are my other sources of income? And how much do I want or need to spend? The not so basics are: what are reasonable assumptions about rates of return, inflation, how long am I going to live? What are taxes going to look like over time? And how do I deal with market volatility? So if you were a couple that came to us in the fall of 2021 and said, hey, we're 65, we're going to retire on Christmas Eve. We've got $2 million in an IRA. How much money can we spend, and what would that look like? So we'd go to work. We'd tell you to unless there's some unique circumstance, we tell you to delay retirement to age or Social Security at age 70. We'd say from a planning standpoint, while median mortality would say for men, it's probably 85 and ladies, it's probably 88. From a safety standpoint, median really means 50-50. And so from a safety standpoint, we'd want to build your plan to last to an age that we were you only have about a 10% chance of living beyond that. For men, that's about 92, and for ladies, that's about 98. We would use the best data we have about forward-looking portfolio returns and standard deviation. We don't create that ourselves. We rely on the big shops that spend millions of dollars a year on research and economic modeling to come up with those. And then we'd apply, again, their long-term capital markets forecasts on inflation. We do assume that you slow down a little bit in retirement, so your essential expenses probably will continue to grow over time at average inflation, but your discretionary expenses might slow down some. Healthcare is probably about twice what normal inflation is. And inflation in itself, as we're still living right now, is volatile, and so we use a standard deviation of about 2.5 on that. So what we would do with that is we'd come back to you and say, given all that information, we think you could spend about $119,000 a year, about $120,000 a year in 2022 dollars after tax. Kind of what that looks like is, this graph on the left-hand side of the line or on the page is before tax income over time and where that income is coming from. So the blue is Social Security, starting at age 70. We assume that the husband passes away before the wife, and so the total Social Security drops off when he passes away. The purple would be normal IRA withdrawals, and then when you turn 72, you have to take RMDs, and so the green are withdrawals from your IRA you have to take to meet RMD requirements. What that would tell us, this is a static look at it, but what would tell us is we're 95% sure that you could fund your retirement that way, starting retirement at 12/31/65 with the assumptions that we have there. What we do with this is we beat it up statistically and say, there's a distribution of returns for portfolio, there's a distribution of returns for inflation. And so we'll run literally thousands of cases of different pairs of return and inflation to give us a kind of a forward view of what might your asset inventory look like over time. And obviously, the further out you get away from retirement, the more uncertain you are. But this range of this graph is referred to as the 80% confidence interval. There's a 10% chance you might end up at the second to die age of 98 with more than $4.2 million. And there's a 10% chance you might have less than $500,000. And so the expected case is about $2 million. There's a decent case that the expected case is that there'll be $2 million either to leave to heirs or to cover unexpected healthcare expenses and long-term care expenses along the way. But anyway, this picture would say we're 95% sure you can do this statistically. And so, that is interesting, and that might provide you some comfort, and you may decide to go ahead and retire on New Year's Eve, December 31st. And then lo and behold, we get to Mother's Day basically, and the market's down 15 to 20%, and you're wondering if you made a mistake to retire. It's creating doubt and uncertainty. It's like, well, did I make a mistake? I'm gonna have to go back to work. Now what? Well, to answer that question, we felt like it might make sense to go back and say, well, let's take, this couple essentially retired at the high water mark of the market. And so we thought, well, let's go back in history. Let's find 3 other fairly significant financial events. And let's take the same couple, let's inflation adjust their assets and their income expectations back to the high water mark right before each of those events. And let's see what happened to them from that point forward. Those three events were the global financial crisis that everybody knows about. Started in October of 2007, really bottomed out in early March of 2009, and started a long climb back. The other one that most people probably remember is the dot-com bubble that burst in early 2000. And then the other one that a lot of folks would remember is the bond crisis that happened in the fall of 1987. That's become lovingly known as Black Monday. And so what we did, let's go back and let's assume that this 65-year-old couple in 2031, adjusted for inflation, retired in October of 2007 at that high water mark, in January, February of 2000 at that high water mark, and then in September, October of 87 at that high water mark, and see how they did. So again, retired at high water mark, both 65. We kept we adjusted their assets and their spending for inflation from 12/31 back to the date of the event. We assumed a 4 asset class, 60% stock, 40% bond ETF portfolio. That's not really, you can do a whole lot better than that, but we wanted to keep it simple and see how it worked. If you tuned into part one, you'd know that a 9 asset class portfolio would do better than this, but we used a 4 to kind of to be conservative, if you will. We assume constant spending throughout retirement adjustment for inflation, and we use the actual daily return of the market and the portfolio from the time they retired through the analysis. We use the actual period monthly inflation. We use the then current applicable tax rates. We use the then current Social Security benefits, and we assumed that they stayed invested throughout this whole period of time. The only thing we did to the portfolio was every year at the end of the year, we rebalanced the portfolio back to its initial 60-40 target with this allocation. So again, our first couple that retired 12/31, they said they could spend about $120,000 a year, and they had $2 million in their IRA. In 2007, October 2007's high water mark in the market. That $2 million in 2022 would have been equivalent to about $1.4 million and change in 2007. Again, same portfolio, start retirement at age 7 or Social Security at age 70. Portfolio returns were a little bit more favorable from a forward-looking standpoint at that point in time. Inflation was certainly a little bit lower than it is right now. Made the same assumptions about longevity. Certainly, we used the tax rates at that point in time. So that couple on the same basis could have, that $120,000 in 2022 is about $61,000 in 2007. So if that couple retired in October 2007, how did they do? So, just like our couple that retired at 12/31, right after they retired, bottom fell of the market actually went down 56% in the course of about a year and a half. Obviously, they had to be really concerned about what was going on. So this is not the market. This is their portfolio over time. So they retired, they had about $1.4 million. They suffered through the great financial crisis, bottomed out, kept coming back, dealt with COVID, came back, and dealing with what we're dealing with right now. And so what you'll notice is they actually have about 30% more assets than they started with. They funded their retirement all along the way, and now this couple is 80 years old. So they've weathered some pretty good storms. They've enjoyed a pretty good run in the market, but they've weathered 3 pretty significant storms. They're not quite to median mortality, but they've done pretty well so far. Let's take another couple, same process. Let's assume that same 65-year-old couple kind of time machine backed up, retired in March of 2000, right before the dot-com bubble burst. And so $2 million in 2022 is about $1.15 million in 2000. Again, taking Social Security in 70, using the rates that were applicable then. 120,000 in 2022 was 50,000 in 2000. Portfolio returns at the time, inflation at the time, tax rates at the time, how they do. Well, just like our other two couples, right after they retired, the market dropped over the course of about a year. .com bubble caused the market to go down about 47%. So this couple, they retired, they stayed invested, they suffered through the .com bubble. A lot of people call the decade of the 2000s the lost decade. The truth of the matter is the S&P index was almost exactly what it was at the end of that decade is when it started. But again, these folks aren't in the S&P, and so they actually saw their portfolio grow, suffered through the great financial crisis, saw their portfolio grow back, suffered through COVID, and in this current interest rate, Ukraine, supply chain driven market issue we're dealing right now. So this couple now is at median mortality for the most part. But again, they've got about $200,000 more than they started with. Let's do this one more time. Let's back up to Black Monday. 65-year-old couple retired in August of 1987. Black Monday happened in October of 87. So $2 million today would be just a little bit more than $750,000 in 87. $120,000 a year spend today would be about $40,000 a year in 87. Used portfolio returns at the time, inflation at the time. So again, just like our three other couples, as soon as they retire, bottom falls out of it. It happened a lot quicker here in the course of about 2 months. The market dropped 32%, kind of like COVID, if you will. So how did they do? So they suffered through Black Monday, recovered, saw a great rise in their assets through the .com bubble, suffered through that crash, gained assets during the lost decade, if you want to call it that, suffered through the great financial crisis. Things came back, suffered through COVID, suffered through the Ukraine Fed rate hike, supply chain issues. That couple, if they're still alive, would be 100 years old now. But interestingly enough, they have about $1.1 million. They've got a little over $1 million, not quite $1.1 million, and they started with about $750,000. So in the face of all, they suffered through really 4 fairly significant events, and they still have money. They still have money in the tank. To kind of put in perspective, the folks that retired at the beginning of the global financial crisis, they'd be 80 now. They started with $1.4 million. They have about $1.97 million right now. When we were talking to them about retiring prospectively, we were told them that they have a 95% probability of success. If you look at, because they've gained assets, if you look at where they are today, forward looking to the second to die of the couple of age 98, we'd tell them that their probability of success is statistically about 100%. And we'd expect their portfolio value, even after spending, portfolio value at age 98 to be about $2.4 million. .com couple, they would be at median mortality now. They started with $1.15 million. They're about $1.35 million now. Again, on a forward-looking basis, we started at 95% probability of success when they retired. Forward-looking from here to age 98, we tell them they're at 100%, and we'd expect their portfolio value to be slightly lower than it is now, but still about $1.3 million, which is still about roughly 10% higher than where they started with. The couple that the Black Monday couple, if they were still alive, they'd be 100. They started out with just a little bit more than $750,000 million. Again, if they're still alive, they'd have $1 million, almost $1.1 million. If you backed up 2 years at their age 98, their portfolio would have been about 937. So all three of those folks, stayed in the market, did some fairly basic discipline, and they financed their retirement just the way they wanted to, with money left over. Now that money left over might be something that the heirs get, but also might be additional safety safety net for long-term care, higher medical expenses, those kinds of things. That sounds interesting, and I think that ought to be reassuring. We can't predict the future, but looking at things over, a 35-year time frame, we've been through a lot of things, ought to give us some clarity and confidence about having a plan and sticking with it can work out pretty well for you. But still, with all the news and all the market drops, it still creates, this kind of human desire to, shouldn't I do something? Well, we wanted to test if that doing something was to go to cash when the market drops. How would that have? What would that have done to you or for you? So take our great financial crisis folks, retired in 2007, and and then we assumed that they got out on kind of what the market watchers would call this point of capitulation. So when markets fall, some people say sell, some people stay in for a while. At some point, the pain gets too high, and they talk about that as capitulation because the market's gone down. People are afraid it's going to go down even more, so they get out and wait for better days. That's called market capitulation. And so we went back in each of these three cases. We looked at the highest volume trading day during these falls and said, okay, that's kind of market capitulation. If people are going to get out, that's when most people would have got out. And so that's how we picked this day right here. So the market did go further, but we were able to get out before it hit bottom at the end of March. So this top line is the line of what their portfolio would have looked like had they stayed invested. The bottom line is what their portfolio would look like had they adopted the go to cash and kind of protect myself and wait for things to get better. And so, they suffered. They kind of reached their capitulation point in October of 2008. They stayed in cash for 6 months and then participated with however the market did. But then again, if they were inclined to go to cash to protect themselves in the 07 to 09 timeframe, then they probably would have done the same thing at COVID. And so if they got out of the market on capitulation day there and stayed for cash 6 months, where they'd be today is they'd be down about $1.2 million from where they would have been otherwise. Let's look at our tech stock, or our tech bubble crash, folks. Capitulation day in that event was about July 23rd, 2002. So if those folks went to cash at that point in time, stayed in cash for 6 months, if they were inclined to do it at the .com bubble, they probably would have done it in the global financial crisis time. Again, same capitulation date as before. Go to cash 6 months. If they capitulated twice before, they probably would with COVID. And so in that case, they're down about just shy of $700,000 where they would have been otherwise. Again, our third couple that if they're still alive would be 100. The 87 crash happened really fast. That capitulation time was October 19th, 87, which actually turned out to be the bottom, but you wouldn't have known that at the time. So anyway, if they capitulated at Black Monday, same thing in the .com bubble, same thing in the global financial crisis, they actually would have run out of money in their early 90s. And so, I don't know if they would have gone to cash, but if they did go to cash, a lot of people do. If they do go to cash, trying to do something to protect yourself can actually hurt yourself in the long run based on this historical views and actual daily returns and actual inflation, those kinds of things. So to kind of put it in summary, if you take our couple that retired in 07, started out with $1.4 million. The value this year, beginning of this year, would be about $1.97 million. And we would expect their portfolio to be about $2.4 million at their age 98 if they live that long. And that's spending, the 2022 equivalent $120,000 a year, inflation adjusted. Our .com bubble folks, they started out with $1,150,000. 2022, they had $1,350,000. And by the time they are 98, we'd expect that portfolio to be about $1,300,000. Our Black Monday folks, they're still alive, would be 100. Started out with a little more than $750,000. Beginning of 2022 to have $1,100,000, almost $1,100,000. They'd be 100 here, so their age 98 number is a little bit lower, so it kind of makes this graph a little bit awkward. But still got gas in the tank to help them with long-term care, inheritance to their heirs, whatever makes the most sense for them. So again, in each case, at the beginning of their retirement, from our approach, we would have told them we're 95% sure they can fund their retirement the way they want to. The way the returns actually came out on a forward-looking basis from today to age 98, they would be at 100% probability of success. By comparison, though, if you were of the bent to go to cash, our global financial crisis folks made $4 by capitulating in 2007 and in COVID, and probably now. That would have cost themselves about $600,000, a little bit more than $600,000. And on a forward-looking basis, that would say that they're probably only going to have about $425,000 left at age 98. Our .com folks, $1,100,000 by capitulating, they're about half where they were before, a little bit more than half where they were before. And we would predict that they would be out of money before they get to age 98. Our folks that retired at Black Monday, they were out of money in their early 90s or mid 90s. So again, in each case, adopting our approach to portfolio management, we would have told them that at their spending level, they'd have a 95% probability of success. By capitulating and going to cash when things got uncomfortable, the folks that are now 80 that retired in the great financial crisis, their forward-looking probability of success is only 63%. The folks that retired at the beginning of the .com bubble and capitulated, they're now 87 median mortality, but their forward-looking probability of success is only 39%. And our folks that retired at Black Monday, they ran out of money in their early to mid 90s, and so they've kind of hurt themselves. All three of these folks have hurt themselves, but these guys put themselves in pretty significant financial jeopardy. So the conclusion is, news and reality as it relates to your financial security can be quite divergent. Doesn't mean there's no truth in the news, but how they kind of help you try to interpret the news, and that isn't always accurate. Capital markets have historically been political party agnostic. They've been very resilient in the face of some pretty bad things. We tend to forget things the further we get away from them, but when 9/11 hit, things looked pretty bad. When the great financial crisis hit, things looked pretty bad. I remember a good friend of mine was a bond trader with Black Monday. He thought his life had come to an end. So when you're in the middle of these storms, they look pretty bad, taken out of historical context. But when you put them in historical context, again, they're not comfortable, but they may not be the Armageddon that sometimes it's easy for us to assume that they are. Sticking to a well thought out plan allows us to weather very dramatic economic and market upheavals. That market discipline has demonstrated to serve investors well over extended period of times historically. And conversely, doing something in the face of turbulence can severely compromise your financial security. The other thing I wanted to kind of mention now, we talked about how you can improve your odds. We did all that analysis based on a 4 asset class portfolio. If you watched part 1, we talked about how you can improve your portfolio performance by going from 4 asset classes to 9 asset classes. I don't want to make this a sales pitch or give away our secret sauce, but we go further than 9 asset classes to do some other things in the portfolio, primarily focused on reducing risk, which further shifts this risk return profile up and to the left. And so if that couple that retired in December of 2031, we told them based on a 4 asset class portfolio, they could retire on about 120,000 a year, inflation adjusted. If they would have adopted a 9 asset class portfolio, that number jumps up a little bit to about 125. But if you go to the Arete Advanced portfolio, that number is more like 150. So that gives you about a 25% increase in income. Now, you may not need or want to spend that income, but what that does is leaves you more dry powder for unexpected expenses, long-term care, or to pass on to the next generation. So thanks for your time and attention. I know these have been a little long-winded. Appreciate your participating. I'd love your feedback. Happy to answer any of your questions. We'd be honored to take a look at where you are and see if there's some improvement that we can do for you. Perhaps we can be, if you're not already a client, perhaps we can be a resource for you or somebody you care about. Please give us a call, and thank you for your time. And please remember that this is not intended to be financial advice or tax advice, but we'd love to talk to you and see if we can be a resource for you. Thank you very much, and have a great weekend.